Welcome to another edition of Money Talks. I'm Jerry Slusiewicz, your host. This is our videocast edition. We're trying to update you and educate you on how to become a better investor. These supplement our writing that we do here, and we're trying, whether it's a podcast, a videocast, or in writing, to help you understand what's going on with the markets. Well, the markets have been in correction since April of this year. And it's a matter of, is this a correction in an ongoing bull market that started March of 09, or is this a correction that's going to be a continuation of what's called the secular bear market that started back in March of 2000. Now, a secular bear market is something where you have long periods of time of down followed by brief upturns as well. So 2000 to 2003 down, 2003 to 2007 up, 2007 to 2009 down, 2009 to 2010 up. You know, this could go on for years. If you look back in history, we had 1929 to 1949, 1966 to 1982. There have been several of these things, and certainly from 2000 to even today, if you look at the NASDAQ, it's about half or less than half of where it was, and the S&P and the Dow Jones are still off 30% from where we were 10 years ago. So now, is this a bull market or not? A lot of very smart people have written quite a bit on the subject. It's a very tough discussion. What I try to do is, instead of trying to figure out these long-term patterns, is let's watch what it's doing today and try to take advantage of it. Well, the market peaked out back in April, and we've seen a series of lower lows and lower highs. It's forming the zigzag pattern, parallel lines going down. Now, support on the S&P is 2140. It's held around 3 times, and on the NASDAQ composite around 2139. So each time it's held at those levels, it's bounced back up. That gives support to the bulls. However, 1106 is acted as resistance here on the S&P. It's the 200-day moving average. Every time it hits around there, could be as high as 1115. It seems to be failing. You're not going to really get an all-clear signal until we break above let's say 1150 or 1170 on the S&P and around 2340 on the NASDAQ. Because of longer term, what we see is we see this rolling over pattern on both, where it goes down, a shoulder, then a head, and then possibly another shoulder forming here. These things don't mean it's going to happen, but it's a head and shoulders pattern. And it's a classic bearish pattern, which would mean the market would drop precipitously if we break below the 2139 on the NASDAQ composite and 1140 on the S&P. I would be very cautious. I would put stops in there and be very cautious and use stops. Look back at some of your positions if you don't have the broad indices and see where the recent lows were and use stop losses below those levels. Now, many of the things that had me concerned, such as being exuberantly overbought, too much bullishness, too many stocks above their 50 or 200-day moving average at record levels, many of those conditions have relieved themselves. So I'm somewhat neutral on the market right now. We've got a lot of cash. We do own some commodity issues: gold, silver, natural gas, and sugar, all owned by exchange-traded funds. We own gold miners as well. We're looking, we might enter into some of these equity positions. Things do look like they kind of want to go up in here, but is it a trade? That's what I'm concerned with. This might not be a long-term investment. It might work out that way, but for now we're looking at a potential trade because we're in this trading range, not necessarily in a new bull market. Unless we get the all-clear signal again above 2340 and 1170, 2340 on the NASDAQ to 1170 on the S&P, I would say we're in this trading range, and it's best to be cautious in there. The biggest concern that I have for the markets in the economy is the amount of debt that's been created. This is not just here in the United States, it's global debt. We're seeing a lot of states have problems. The state of California, their budget has to be balanced. They have a new budget starting July 1st, just a couple of weeks out. I think these states are going to need a bailout. How the markets react to another bailout is going to remain to be seen. How the bond vigilantes react to that remains to be seen. But for now, we're in this trading range. But one of the best things about being in the trading range is your downside risk is clearly identified. Your downside risk is the recent low. So if you are trading, or if you've done nothing and just been a buy and hold investor, use the recent lows as your exit in case things go wrong. Because how bad can they go? Well, we've seen the market drop at a rate of around 13%, 18 of 21 times. It's happened 21 times in the last 70 years. 18 of those 21 times, the market had an additional 10% or more decline. So the odds favor that it could go down some more, but again, you could play the upside, but I think that's a trade until we get the all clears. Just keep listening to these podcasts. Sign up for our free email newsletter. You can see the tab right up above my arm here. It's a free, no obligation educational newsletter. Click on it, send us your email. That's all that's required, and we'll send you out our updates. Check in occasionally to our website, www.pfpinvest.com. Again, this is Pacific Financial Planners. Call toll-free 800-449-9501 for your free, no-obligation portfolio review. We can help you become a better investor. Take care.